Welcome, folks. Today I'm joined by our founder and managing principal, Kelly Buckley. My name is Eric White, and I'm managing director here at Spectrum Financial Alliance. And today we are proud to be speaking with you specifically about some of those common mistakes that occur when you work with the wrong type of advisor, right? And we've seen this time and time again, over and over. Would you tell us a little bit about, Kelly, why you think working with the right type of advisor is so important?
Well, I think one of the reasons is I've done pretty much every way of delivering the business. I started with a wirehouse brokerage firm at Merrill for 8 years, and then went to an independent broker-dealer, and then became a hybrid, half registered investment advisor, fiduciary, and half broker. And then many years ago made the decision, after working through all those business models, that the best way from our client's perspective to deliver our services and do it well was as a pure fiduciary advisor.
So you've really seen the spectrum, as it would be. No pun on our name, right?
Yes.
But purely the spectrum.
That's true.
Talk about some of those conflicts then that you observed or that you saw as a broker, as a hybrid, and some of the stuff that we see today.
I think the conflicts in the stock brokerage industry are pretty much the same in the insurance company industry too.
Okay.
There's definitely a bias towards higher commissions. There's a driving of the salesman, and that would be your insurance agent or your stockbroker's behavior, by offering extra incentives on the sale of certain products, or rewarding individuals with trips if they hit certain goals or sold certain things. And there's a lot of pressure on management in those offices to produce at certain levels for certain things. So it's no longer the client is first, it's the firm is first. And that gets to another conflict. Your oath of loyalty, your fiduciary duty, is owed to the person that pays your income. And in this case, when you're talking about a stock brokerage firm or a brokerage firm, it's the company they work for. In a fiduciary registered investment advisory firm like Spectrum, we are directly paid by our clients. Our decisions are made locally, not at a great distance. And there's about 100 other conflicts I could cover, but that gets you a flavor for it.
Well, but that's one of the reasons why one of the questions that we recommend people ask a potential advisor that they're working with is, hey, how do you get paid?
Yes,
right?
Absolutely.
And that way you can help a little bit understand, if you're dealing with somebody that is a true fiduciary, you're going to know the difference. And it's going to be based on those conflicts of interest. If there are sales contests, if they get paid commissions, all of those things are big red flags.
Absolutely.
Okay, good. Another thing that we have seen is when you're working with the wrong advisor, sometimes you're dealing with prepackaged products that have upfront sales charges or back-end loads. That can really make somebody feel like, man, I've lost the liquidity of my assets, right? When you've had that experience with prospective clients, how have they expressed that to you?
So, Eric, for 36 years, virtually every account that has come to our firm, predominantly by client referral, we see signs of exactly what you're talking about, where people are essentially trapped by back-end load charges, primarily in the brokerage account, or surrender charges, primarily in the insurance business. And the loss of liquidity that you just talked about is the key thing, because we work pretty hard here to produce returns in client accounts. And more importantly, the clients work pretty hard to accrue the capital, to save the capital, so it could be invested wisely. And then they find that essentially their money is being held captive, and they have to pay a ransom
just to get it back.
To have the use of the money. And so we are vehemently opposed to the use of products that have back-end loads or surrender charges.
Yeah.
And we believe that those structures are intended not just to trap the client's money, but to give the clients specifically less opportunities to use their capital in the wisest and the best way moving forward.
So a true fiduciary like SFA cannot and will not utilize those types of products.
Legally cannot and ethically will not.
Understood. Okay. So one of the things that we've seen from time to time is when an individual is working with an advisor, sometimes they're working with somebody who's relatively new to the industry. What are some of the criteria that SFA adheres to as far as managing assets and having that background?
That's a really good question, Eric, because if you do have proper criteria, you can eliminate 90% of your future problems in your investment account. And I think I've lived the criteria. I would never have gone into the industry that is entrusted with managing the financial futures of individuals who bring their money to you for competent performance had I not already had a master's in finance or investment or economics,
Sure.
something related to asset management. I also think it's critically important that when you're vetting people who might be managing your money, that you look for long periods of experience. And I'm going to say a minimum of 10 to 15 years. That would get you 2 to 3 market cycles. A market cycle is an up and a down movement.
Right.
And give the person advising you the opportunity to see various parts of the economy work so that they know how to react. And then, the temperament, proper investment temperament is really critically important too. And you have to assess that. Do you have someone who gets embroiled in the issues of the day and allows that to distract from the opportunities of the day? Every issue presents an opportunity. There's always a way to make money in the markets, whether it's in a fixed income portfolio in a declining interest rate environment, not what we have now,
Sure.
or a equity portfolio coming out of the cusp of a recession, the depths of a recession, or entering a period where growth is likely. So you want someone that has the understanding of the markets that's gained by experience, the understanding of the markets and investments that's gained by higher levels of education and certification. So you know that person's held to ethical standards, they get continuing education, etc. At our firm, I've always said that, in the future, whoever manages money for Spectrum has to have the appropriate masters,
Right.
has to have the appropriate level of certification in addition to the masters and the experience.
Those are the prerequisites.
Yeah. Last but not least, one other. Demonstrated performance.
Okay.
And anyone who tells a potential client that they can't tell them how their clients have performed because every client is different is merely trying to hide their numbers.
Maybe they're not as proud of them as we are.
Exactly. Mm-hmm. If you're proud of your performance, you're going to advertise your performance. If you're going to advertise your performance, you should do so comparing it to relevant indices.
Okay.
And that's also why at our firm we sit down with every client at the beginning of each year to go back over the last year's results at no cost.
Wow.
And show them how their account performed net of costs versus the relevant indices.
And that's different than what we've seen from the vast majority of other investment advisors
Absolutely.
out there.
Very uncommon in the industry.
So, one of the things that we bring up to, again, potential clients is how to check what sort of credentials or if there's been problematic issues in an advisor's background. And we do that by recommending that they go to brokercheck.org. Would you share with our audience some of the things, some of the crazy stuff that we've seen on those reports?
Most of them are going to show you immediately that there is no advanced education because
Okay.
they list it. They're going to show you whether or not the individual has professional credentials, accreditation as a certified financial planner, a chartered financial analyst, etc. They're going to tell you a lot that helps you vet the individual because it'll show who they've worked for, how long they've worked there. We
Okay.
see a lot of job hopping in
Sure.
the industry.
Yep.
And they're also going to tell you if there are termination events. They're going to tell you if individuals have past bankruptcies.
Which we've seen. Tax
Yes, we
liens.
have. They're going to tell you if the individuals have felony charges or convictions. Those are the type of things, Eric, that when we look at individuals who are currently advising folks who are coming in and asking us to compare their account performance versus our own historic actual achieved net numbers, we're seeing a lot of red flags that would be a precursor to a decision not to even talk to an individual about managing their account.
So use that tool.
There's a wealth of information there.
Excellent. Okay. So working with an advisor who doesn't get to know your personal situation or not getting a plan with a certified financial planner, I guess the analogy that I've always given people, it's like taking a road trip. If you don't have a map, you shouldn't be surprised if you get lost, right?
That's right.
So, talk about some of the issues that you've seen from people who call themselves a financial planner, but really are not a certified financial planner.
Well, we believe that advice should be personalized directly to that individual client. That advice that's being rendered when it pertains to financial planning should only be given by a certified financial planner, not someone calling themselves, which anyone can, a financial planner without the benefit of the education, the years of experience requirement, and the demonstrated professional competence of a CFP.
Again, another one of those red flags that we would want to avoid.
Absolutely.
Kelly, I want to come back to something that you mentioned earlier that I thought was pretty important. The excuse that I can't provide actual demonstrated results that I've given, that we perform for clients, something that we do and we're very, very proud of.
And you're talking about investment results.
Investment results. And so we see things, they'll give someone a proposal and talk about a back-tested model. Could you explain to folks a little bit more about what that is versus actual demonstrated performance?
Yeah, I will. And let me refer to something, Eric, I think will help illustrate this. During my first 8 years in the industry, when I worked at a brokerage firm, and I'm saying from the very first year, I met with every client to go over their previous year's performance. Exactly. And I did compare it to relevant indices as we talked about prior. But the interesting thing was I was not only heavily discouraged from doing that, I was basically told not to do that. It resulted in many discussions between me and the office manager.
I can imagine.
And I did it anyway. But they don't want you to do that because most of the time in those situations, there's not much to be proud of in the performance arena. We are proud of our numbers. That's why we present them. But one of the things that we've seen, and I'm saying the vast majority of the time, at least 98% of the time with new accounts coming in, is they've never had a performance review. And to me, that's an admission by their investment advisor, by their brokerage firm, their insurance agent, that their performance is extremely poor because you don't want to talk about it.
Sure.
Right? So there's another key, let's call it a clue here, when you're talking to someone about managing money that I think folks need to be very aware of and looking out for. And that is the use of hypothetical results. This is where whoever is advising you sits down and shows you a portfolio. Most of the time it contains mutual funds and managed products that have high internal expenses that are basically not transparent. They're very opaque. But they show you this hypothetical, and then they say, yeah, this portfolio over the last year was up X percent. Over the last 3 years, it was up X percent. The problem with hypotheticals is it allows that person or that firm to cherry pick what worked in the past with the benefit of hindsight, which in this industry we don't have.
That's Monday morning quarterbacking.
Exactly.
You can't do that.
Which is exactly why Spectrum Financial Alliance advertises we are a concentrated and predictive style. We put money in front of things we think will naturally evolve out of current events, and that, I believe, explains in great part the advantage our clients have in terms of investment performance versus the markets and other service providers. So if someone comes to you and shows you a hypothetical, understand that fiduciaries cannot do that. It's illegal. And it's illegal because it ill serves the purposes of that client.
It could be misrepresentative.
Absolutely.
Yeah, yeah. Well, folks, we've talked about a number of the pitfalls today. Hopefully, we've hoped to avoid a lot of those. If you'd like to start the journey with us here at SFA and have a true fiduciary plan put together by a certified financial planner, please give us a call. Thank you, and God bless.